Hello and welcome to episode 193 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me at last. I'm back. It's Andy Leeds. Damien, how are you doing? I was booted off last week. What happened there?
You were sent into exile. No, welcome back, Andy. It's good to have you back.
I have to say that obviously I'd still do the editing and stuff, and I received the audio file, and I was just a tiny. I mean, this is my needy side. Tiny bit hurt when you said I'm really sorry to say we've got no Andy this week, but I'm really hugely excited to say we've got Pete. Even better news, we've got Pete on the podcast, and it almost seemed like you were happy that I weren't around. So I was a little bit hurt.
Never mind.
By the way, can I just say I listened to last week's episode, and Pete, I know he does listen. I thought it was a really good episode, and it was nice to actually listen to an episode as a listener, just to, I hate the sound of my own voice, as most people do who do podcasts and radio and stuff. So it was really nice to hear Pete and what he did, and I went and bought his book. So I added one to his sales.
Oh, did you? Oh, I'm impressed, Andy. I got a free copy, so I didn't actually pay for mine, but it doesn't matter. Yeah, I think he's having some success with his book. I think I saw that it was creeping up the personal finance chart. So if you were interested, then listen to last week's podcast. But how have you been anyway, Andy? Apart from crying into your pillow at night because you were booted off, have you been okay? What have you been up to?
I'm really good. I've been super busy. In a way, it kind of helped me last week. Just work-wise, it's been one of those torrid couple of weeks, but we'll get through it. Exciting stuff happening with our youngest daughter. She's started school full time now. They do this weird thing where they settle them in, and it seems to take like 3 or 4 weeks for them to finally be going to school properly. She's been doing afternoons for a couple of weeks, but she's finally started her first day at school. She's super excited. She skipped in, and it's happy and sad times really, because my wife is going to miss her company.
But it's good to see that, or hear that she's enjoying it, because that's the worst thing. If they come along and if they don't enjoy it, my youngest has gone to preschool, and so she's enjoying it at the moment. And I say at the moment, they always have a wobble, but there we go.
How's your week been anyway?
It's been pretty good. I tell you what, there's a theme to my week, and it's about solving people's finances. And I know you may think that's kind of what we do a lot of at Money to the Masses through content and podcasts, but this week, if you follow me on social media at Money to the Masses has exploded. And if you look on Instagram, on Twitter, on Facebook, we're putting out loads of content now that's specific to each platform. So it's stuff that we don't cover anywhere else. It's a reason to start following us on social media. And I'm pretty excited about it. But one of the things you would have seen is I went to Brighton this week. And Brighton is where we assembled the Avengers, effectively. The Avengers of the finance and tech world, in a way. That we're trying to build a product or a service that's going to help people with their finances en masse. And that is the autumn project, which will be out by the end of the year. So we had a brainstorming day where it's more of a workshop where we all together, and I couldn't share too many pictures from within that room, because if you imagine when we were brainstorming how it's going to work and what we're going to build and everything, that they plaster it all over the walls. And so if I take a picture of any direction, it basically gives away everything that we're doing. So it's a bit of I want to keep some of that behind closed doors, but it'll be exciting. And obviously listeners will see it firsthand when it's probably nearer to Christmas and in time for the new year. And it was quite timely because I'd been helping one or two people who I know personally just asked me for some, not advice, because I don't give financial advice, obviously, but some tidbits of direction, things to look at regarding their finances. And there was a listener called Sarah, actually, who's been particularly what's the word? She's been in contact quite a bit, actually. I asked about things for females and whether our podcast had enough for females and what we could do more of, and she's come up with some fab ideas. I was going to go through her email in sort of detail because there's some good points in there, but what I was going to do, or thought I would do, is pull out some more scenarios that are related to certain types of people in terms of whether you're not just by male and female, but life events. And one of the ones I did this week when I was talking to somebody I know, it was quite interesting because they had a life event. And so one of the big pieces this week is somebody who has said, I've not done anything to do with my finances. Where do I start? What do I do? and they're just about to have a baby, and it was just giving them the key things that they should be looking at and trying to resolve. And that's a life event, so it's kind of inspired by Sarah, it's inspired by things I've been doing all week, and I thought it'd be very useful for people because they can take out bits that relate to them. So that is actually a way of telling you one of the pieces this week. I'm also going to talk about current account switching. Now that is timely because it's the 5th anniversary of the current account switching service, and that's the service that helps you seamlessly switch current accounts. So people still don't do it, but it's 5 years since that was launched. I'll talk about that and actually some of the incentives that are out there. Now, it might slightly date the podcast if you listen in the future, but interestingly, a lot of these incentives never change. They stay around for quite a long time. So when I reviewed them this week, many of them were still the same as they were 6-9 months ago. So I'm talking about that. And one of the others is some myths. Now, income protection is an insurance we talk about from time to time on the podcast. And when I interviewed Pete last week, we talked about insurances and about preventing disaster, or not preventing, sorry, insuring against disaster. And one of the key ones that people overlook is income protection. So I thought I'd look at it in a different way and talk about the myths as to what is income protection, just to remind people what it is, but some of the things that people think are true and why they don't take it out or even consider it, and I'm going to say whether they're actually fact or fiction and tell you the truth.
Beautiful. So what shall we start with this week?
Let's rattle off the easy ones before I get into the slightly meatier financial plan, as it were. Now, I'm going to do the current account switching first. Now, the current account switching service was 5 years old this week, which was why I started talking about it. You would have seen me talking about it on social media. And I don't know, have you ever switched your current account, Andy?
I haven't. So this is talking to me. I've recently thought about it. Do you know what? The reason I haven't, it was more fear than anything else. I was just a little bit apprehensive about doing it. It's a bank account I've been with ever since day dot. I was worried about maybe my credit score changing, or as a younger man, I was almost in fear of doing it because of the fact that I had overdrafts and all this kind of thing. As I've got older, I'm in a lucky position where I don't really have that concern anymore. I don't have any loans with my bank or overdrafts. So actually, there's nothing that means that I should stay with them. So you're going to be talking to me in this pod, Damien. Have you switched?
Have I switched? Good question. I have switched. Well, do you know what? I don't think I've ever. Yes, I have. The account I have now, I switched to many moons ago, before the current account switching service existed, and there was an incentive. So I have, but I still have the previous account. And I show you the evidence shows that people change their partners more frequently than they do their banks. They're more likely to get divorced than they are to change their bank. So you and I are evidence of it. Most people are evidence of it. And there's been a certain number, I can't remember the number, million switches, but actually the vast majority of people still haven't made a switch, despite the current account switching service existing for 5 years. So let me just cover off what it is. It's basically a service to counter that fear that you described, but also to ensure that any switch that happens is processed correctly by the relevant bank. So the key facts to remember about the service is that if you decide to switch current accounts, then the whole process will not take more than 7 working days, which is basically a little over a week. What also is important is that the direct debits and standard orders that you have will also be automatically transferred across to the new account. So the banks will sort this out. You go to the new account and say, the new bank, I'm going to switch across to you guys. The process will then be taken care of when you give them the details of where your previous account or your existing account is. Now, what happens to if somebody tries to pay money into your old account, then for a period of 13 months, they will make sure the money goes to your new account. So really, there is no reason other than inertia to not switch accounts. Now, the thing is that banks are now offering good incentives to make you switch. And some of the incentives, which I'm going to quickly run through, are First Direct do one, and their incentive to switch current account is they'll give you £150 gift. Now, that's up front. So the gift they used to do gifts in terms of cash, but now they do it in the form of an Expedia voucher, Bose headphones, a Polaroid camera, which I thought was quite interesting. A bit retro, but obviously I think they're quite expensive. A Fitbit, an Amazon Echo Spot. So you're getting something that's worth £150. And then you get another £100 if you decide to leave after 6 months, but before 12 months. So it's really, they're giving you an incentive to come, but you know what? They're so nice. Even if you don't like them, they'll pay you when you go. Now, with all these incentives, there usually is a caveat. So for them, you have to pay in £1,000 a month regularly. We'll come on to that in a minute because there is a trick which you can do. Now, other accounts that are doing it, Halifax give you £75 cash if you move, but you have to have £750 a month going into that account and 2 active direct debits and remaining credit. Now, Marks and Spencer's are quite an interesting one because we mentioned it a couple of podcasts ago. They give you a £125 gift card. So for Christmas, that's quite handy. You can get the turkey in if you want to do that. You've got time to still do that before Christmas. £1,000 a month needs to be paid into that account with 2 active direct debits. And HSBC, they give you £200, which is £150 up front and £50 in a year. And that's even if you have an existing account with somebody like First Direct. You do need to have £1,750 a month going into that account with 2 active direct debits. Now, the key thing that most of these accounts, I think it's bar the HSBC one, will require you to close all the previous account that you had. So you can't just get the incentive. And you notice that they try and make it that you're using the account by having direct debits in there. But it is possible to just have the same money going through all of these accounts. So you could theoretically have the same £1,000 a month going in one account, straight out that account into the next account, out that account into the next account in a merry-go-round to secure these incentives. And I know people who've done it and they've made hundreds of pounds over years of doing this sort of thing. I think it's slightly disingenuous. There's nothing wrong with it, but it's easier ways to make money, and it's can be slightly confused. You've got to make sure you stick to the caveats. But the point is, the switching service exists. It's 5 years old. If you've not thought about it, why not? There's some good incentives out there. I'd argue less incentives than there used to be. There used to be more, but I've just named the ones that are out there now. Always bear in mind the Financial Services Compensation Scheme, because if you're going to start moving money in accounts, then you've got to make sure that you're covered under the Financial Services Compensation Scheme, and also it complements the banks that you already have, because don't forget, First Direct and HSBC are essentially the same banks. They've got the same banking license, so you only get the same. You only get one limit under the Financial Services Compensation Scheme, so it's £85,000 per person or £170,000 per couple, so per joint account. There is a tool on the FCA website that you can go to that can check whether the accounts that you want to use or the ones you already have are compatible and what sort of protection you have, rather than trying to work it out yourself. If you go to protected.fscs.org.uk/tools/check-your-money-is-protected. Andy will put that link on the podcast because it's
stressing there, Damien.
We got there, but there is a tool. You Google it, you'd find it. The point is, there's a tool now. There never used to be. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service, let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so Damien, income protection. We're going to cover some myths. What is income protection?
Right, income protection is, let's start with what most people know. Life insurance pays out if you die. Fairly simple, fairly straightforward. There are variations.
Pretty black and white, actually, isn't it?
Pretty.
So long as you're honest on the application forms and it goes through the underwriting process, it's pretty definitive. There's a death certificate issued, and on supply of that, there will be a payout.
Yeah.
Boom.
And what is interesting is that there are other insurances that people can and should have. Now, I say should. In an ideal world, you would have some of the others like critical illness or income protection. Critical illness insurance pays out on the diagnosis of you having a particular illness, and then one of the critical illness listed under a policy. So it's things like most cancers, most serious cancers anyway, and that will pay out a lump sum, which you can do with what you want. Income protection, on the other hand, is something that's it's different. What it does is it pays out an income if you are unable to work, and that could be due to some form of illness, accident, or incapacity. So if you were unable to work for whatever reason, then think about how would you pay the bills. So you're still alive, you're not dead, you're sitting there, you can't work. How would your family survive? And income protection insurance is an insurance that is designed to replace some of your income, and it's up to 70%. And when you think about it, the reason it's 70% is largely because if you take away the tax that you have on your salary, that's about the level that you actually end up having in your back pocket. So it pays out to help you and your family survive. Now, people look at it and go, well, that sounds great, but it's expensive, I'm self-employed, it's not applicable to me. There are a lot of reasons why people don't. And in fact, an interesting stat is that you're more likely to be unable to work for a period of time than you are to die. And that's assuming you're healthy. But people always fear death more than they do the inability to work. So I'm going to run through the myths. Now, the first one is that people go, well, do you know what? Why would I insure against being unable to work? Because I've got sick pay at work. I get paid if I'm off sick. I'm employed. Why do I need it? Now, the thing is that you may get some sick pay at work, but it will only last for a very limited period of time. And after that point, it becomes discretionary often. So your employer doesn't have to keep paying you your salary if you're off for long term. And yes, there is statutory sick pay out there which we're entitled to, which is £92 a week, but it only lasts up to 28 weeks. So what happens if you're off for a longer period of time? How do you survive? Could you even survive on £96 a week? So just because your employer has some sick pay, after a month or so, the chances are you're going to be on the breadline, really. So how would you survive? And that's where income protection can come in. The other myth is people say, well, I've got critical illness cover. Do I even need income protection? Now, as I told you earlier, critical illness cover it pays out if you have a critical illness. So let's say you were diagnosed with a type of cancer. You may have survived. You may be off for a period of time because your health has deteriorated slightly, and you've got this lump sum. And you sit there and go, well, I don't need income protection because I've got critical illness. But they are fundamentally different policies. One pays out if you're unable to work. One pays out if you get diagnosed with an illness. And what it means is the critical illness cover gives you a lump sum. The income protection basically gives you this regular income. Now, once you get that lump sum, you could spend it all and then it's gone. With the income, it will keep going until the end of the term of the policy, which typically will be retirement, or it will pay. Obviously, it will stop paying if you go back to work. So that means that income stream will keep going until you're deemed fit enough to go back to work. And obviously, they're not going to pay you forever. They want you to go back to work. That's the point. But they test. There's ways of the definitions about whether you can go back to work, what it means to be unable to work. And that's specific to each policy. But one of the things that is interesting about the difference between critical illness and income protection, that critical illness is a one-off policy. So you claim once, that's it, it's done. You get another critical illness, it's not going to pay out again because the policy's paid out. Income protection, you go back to work after a year or 2 years, the policy's still there and you can pay out again. So if you get another period where you can't work, it will pay out again. And then you go back to work. So the policy itself can pay out multiple times, which makes it incredibly useful. And with critical illness, the other thing is there's a defined list of illnesses. So you have an illness that isn't on that list, your critical illness policy is not going to pay out. Whereas if you're unable to work, then an income protection policy will pay out based on the fact that you've been deemed and judged not able to work. It doesn't really matter what the reason is that you were unable to work. It doesn't matter which particular illness caused it. It's whether you are unable to work. So they're slightly different. So they complement each other. Just because you have one doesn't automatically mean you don't have the other. Now, the other myth is that income protection never pays out. You'll never have that, make a claim on it. Well, just one stat that's quite interesting. A 40-year-old female has a 3% chance of death by the time she's 65. But she has a 40% chance of not being able to work for 2 years or more. So that's quite interesting. I think that just puts it into light that people have a greater chance of being unable to work. So when you work out the numbers, it basically means you're 10 times more likely to make a claim on income protection than you are on critical illness. And the other one is income protection is expensive. Well, that same woman could have been covered for £1,500 a month for a premium of £43 a month. Well, that puts it in line, not too far away from a basic life insurance policy, to be honest, that most people would have. The final one is self-employed people or people with health problems can't get income protection. Then that's just not true. There are different ways it's underwritten. There's medical underwriting, that's they look at your health and they judge what sort of cover they will give you and the premium. And there's financial underwriting as well. So when they look at your financial circumstances and will look at take into account the fact you're self-employed in your company's books, etc. So you can get income protection if you have pre-existing health conditions or you are self-employed. So it's something worth bearing in mind. Following on from Pete's interview last week, insuring against disaster is important. That's life insurance, that's critical illness, and that's income protection. Have a chat to somebody who is a specialist in providing insurance. There's firms out there. You can look for them on Money to the Masses website, and it's worth working out the suite of insurances you need. You don't need them all, admittedly, as I'll come on to when I talk about the tips that I was talking to somebody about financial plan. You'll see I don't sit there and go on about get them all, but you need to be aware that they're there.
Good. And how would you counter the argument that I often hear, oh, don't worry, I've got some savings, that will cover it? It's in my opinion, that's not always the answer. What are your thoughts on that?
Well, the thing is, the savings is like an emergency fund, and most people don't, and they don't have sufficient. That's the thing. They say you should have 6 months in your savings, 6 months' salary, and most people don't. Just being realistic, because they're not fortunate enough to be able to put that amount of money away. But 6 months, then that's it. You're getting to the point you can't pay your mortgage, you can't pay your bills. At that point, you're going to start defaulting on things. So I think the argument that you have that money, that's great. If you do have significant sums, then you won't need the insurances. But what I'm talking about, that example I said, £1,500 a month, and you could potentially be paying out for 20, 30 years. You're going to need a big pot of money to do that. So that's where these insurances come into play. And it's about getting the budget, getting the right solution for your budget is the point. And everybody's situation is different. It's like me, I've had reviewed my insurances. I couldn't afford as much as I would ideally like, but you can tailor a solution and then you can review it in the future. These things can always be reviewed. You can, as your situation changes, you change the makeup of what insurances you have.
Good, and I think that's key, that last point there. If you're not quite sure and you want a little bit more information, do get some good advice. There's some really good companies out there that will give you advice on critical illness, life insurance. My general point, just from my point of view, because I know this side of the industry, typically I wouldn't go to your bank. They're generally tied to one product or one policy, and why would you limit yourself? Get some independent advice where you can actually have someone look at the whole of the market, and they're going to be best placed to get you the best value Right, what have we got next?
Right, we've got the slightly meaty bit. I'm conscious of the time, but we're We're going to get through it. Now, I was asked the question by somebody who is just like probably a lot of listeners who said to me, Damien, I've done nothing. I've just done nothing with my finances. Now, this person, he was a guy, and he's successful. He runs his own business, and he was just like, look, I've just not ever got around to doing any of this stuff, and I'm just sitting there, like, listening, talking to you, and I'm just sitting there thinking, blimey, I need to be doing something here. And one of the key drivers was the fact that he said, look, my partner and I, we've got a baby coming now, and I've just got to sort it, and I've done nothing whatsoever. Where do I start? And it was that conversation which goes back to what Sarah was saying as a scenario, which lots of people are facing, women are facing, couples are facing, where you get a life event that makes you suddenly sit down and look at your finances and go, where do I start? Now, again, when Pete and I were talking last week, there is a whole range of things that you can do, and it feels like a Mount Everest, but you just need to do the most important things first, and you have to do the things that were going to have the biggest impact, and you have to do the things, you don't have to worry about some of the more esoteric, crazy things that people out there do. 99% of people can just stick to a very simple solution or plan, and they don't have to worry about all the other stuff. There's time to do that. They can review their finances. So I'm going to go through this at quite a pace, but my tips to the person were really, look, here's some things you need to look into. So the first thing they said, to give you a background, they were fairly successful. They had a business they were running, said they haven't got any pensions, they've got no investments, they had a property, they just reviewed their mortgages actually, they had a second property. Well, look, I don't know about life insurances, I don't know about anything really. I'm just sort of thinking, do I pay off my mortgage? Do I, with some of the money I've got spare now? I'm just like, got a plan. And so I went through it with him and said, look, first things first, you've got a baby on the way. Have you got a will? And you need to see, you've got to check you've got a will, because you and your partner are now got to plan what's going to happen if in the event of either one of yours death. And particularly with a will, you can state where your children go. And for me, that was always the most important thing when I did my will, is really what happens to my children if me and my wife were to unfortunately die in very quick succession. So, number one, I was like, look, you've got to go and sort your wills out. And you can do it online, and there are online websites that can do it. But in his scenario, I was like, look, you run a business, you own a business, you own a part of it, you're a director in a business. An off-the-shelf will is probably not going to cut it, because you're going to have all sorts of arrangements at work with your other shareholders, etc., that you're going to have to work out where the business goes and how your wife benefits. Go see a solicitor. Realistically, the price of that is going to be about £1,200 for the pair of you, but it will incorporate, they can decide where his business assets are going to go, how it's going to be passed on to maybe his wife or other shareholders, and also the best way it can benefit his wife and his child. So you can do an online will, but it won't probably cut it for something that's not very simple. You're just leaving stuff to each other. One tip on that, on online wills, if you ever do an online will, watch out. There's been revealed there is one will company, and it's called A 9-Minute Will was the company name, I think. And what they were doing is they were putting in the wills a clause that put them as an executor on every will that was processed through their service. And by doing so, they were taking a 4% charge on the estate for being an executor. You don't need to do that. You can have an executor that does it for free.
Goodness me.
Yeah, and
that's horrific.
Yeah, and it got revealed by one of the national newspapers. I would credit the paper, but I can't remember who it was. And so look for those clauses. Read the will that you get printed out if you're going to use one of those services. So yeah, I mean, it's going to cost people thousands. It wouldn't cost them thousands. It would cost their beneficiaries thousands, your children thousands. So by all means, if you use these services, double check what's in the small print. Moving on from that, I said to him, look, you've got to make sure how is your business, what's going to happen to your business assets? Have you got cross-option agreements at work? Have you got shareholder agreements deciding who can buy each other out in the event of each other's death? You need to have a look at that. And again, the solicitor can do that side. It's the business side and business protection. So what happens if you die to your business, or one of your key people in your business dies? You've got to look at that, because if your business collapses because somebody else dies, that's going to impact your finances, so you need insurances in place. That's business insurance. But that's going to be for the benefit, ultimately, of the business, a lot of that. So that might have to be looked at. In terms of personal insurances, I said, what's going to happen to your partner? What are they going to get if you die? And you're going to have to look at your own personal insurances and how that dovetails with anything you've got at work. Have you got insurance at work? Have you got some sort of death in service benefit? And importantly, what happens if you are unable to work? Because the scenario was that his wife was going to give up working. So what's going to happen there if you're going to be the main breadwinner? So that was, again, speak to somebody who is an independent insurance specialist. They can look at all that and do it all together. It's a very good opportunity to just look at the solution. If you pick somebody who's good, I mean, the Money to the Masses, we talk about it on the website, they will just look at the best. It's like a jigsaw puzzle. They pull the pieces in and plonk them in. But you've got to look at the insurances. The bare minimum, I would always say, is make sure your mortgage on your house is covered. Because if you die and you've got no other insurances, then your wife potentially could end up finding herself having to pay a mortgage or be homeless. Make sure that she's got a house that's secure, and then look at the other things that she's going to be paid out on if you die.
Just to keep this with your listeners that talk about it being more focused on females, obviously if you are a female and it's your husband, it works the same the other way around. Yes,
it does. I'm just saying it this way
You're
round.
just using an example for your friend who's male. I get it.
Yeah, but it's a good point, Andy. I don't want to be seen as being thinking that it's only the men give up work. In fact, a good friend of mine, he's just taken extended parental leave, so he's now the stay-at-home dad, and it's great to see some of I think it was the Telegraph, as one of the newspapers, is now championing that within their own employees, which is great to see. The first question, I suppose, from that would be, I haven't got a solicitor, how do I find one? Vouched4.co.uk will find you a solicitor based on reviews and location, and you can go and search that. Think of it like the TripAdvisor of solicitors, financial advisors, life insurance specialists, all those. It's a great way of finding a reputable. Is it reputable? That's the word. Person. Reputable. Yeah. Potato. Whatever. Tomato. A reputable person who can help you on that. So vouched4.co.uk. Interestingly, he said to me, my wife won't get maternity pay because she actually hasn't been at her job all that long, and I don't think she'll get anything. The first thing to do is look at statutory maternity pay. Everybody's entitled to that if they meet certain criteria relating to how much they've had earnings, at least £116 a week. They've been at their employer continuously for 26 weeks, up to the point of the qualifying week, which is like there's definitions of what that means. So basically,
I actually went through the process of claiming statutory maternity pay for my wife, or we did it together. She had recently quit her job just before she became pregnant and then decided to have an extended period of leave. And we were both thinking, goodness, you're not in a job. How are we going to afford this? And of course, because my wife had paid enough national insurance contributions, we were in a position where we could claim statutory maternity pay. And yes, there's some forms to fill in and stuff. But do you know what? Over the course of the 9 months, we got paid, I think it was, I don't mind saying, it is out there. I think £4,500 maternity pay.
Yep.
And we were entitled to it and well within our rights to claim it. So yeah, make sure you do that.
Andy, when my wife, it's actually my second daughter was born, we did the same thing. She was working, freelancing, and she had built up the period of time. It's that key period of 26 weeks. Look at the definitions of what constitutes it, whether you qualify. And it's actually, you're much more likely to qualify than you think. And also, if you're going to have a baby, you can plan to make sure you do qualify because you're entitled to it. And so what it means is you get 39 weeks of statutory maternity pay from the government, basically. It's 90% of your weekly earnings before tax for the first 6 weeks. And then you get £145.18 or 90% of your average weekly earnings. I'm reading this, obviously, whichever is lower for the next 33. But like Andy says, it ends up being a few £1,000s. So it's one of the big things to make sure you look at. Don't dismiss it. Don't think you're not going to get it. So I'm hoping I'm doing something that's very female orientated here, because for women, that is going to be one of the things that they need to look at, and they are probably entitled to, and your employer won't necessarily point it out because it won't be their responsibility. The Other thing to think about, these are important. I know I've gone over longer than I normally do on a podcast, but another really, really important one is child benefit. Now, child benefit isn't means tested, so when it's technically not. I'll get onto where the confusion comes in, but when you have a child, you're entitled to claim child benefit. And it ends up being about £80 a month for the first child. When you have another child, it's slightly reduced, but it ends up being about £120, £130, something like that in total. And the idea is that you can just claim that. So you choose who claims it. So in my family, my wife actually claims it. And the reason we did that, and I don't mind saying it, is I just thought that, do you know what, if you ever split up, then it's in her name. And I think that's the best way to do it. That was just my opinion. Obviously, I've just celebrated my 10th wedding anniversary. I have no plans of breaking up, in case you're listening, my darling. The idea, though, is that once they claim that you get that money, and it's not means tested. The issue comes that if one of you earns over £50,000, so if you're a couple, if one of you in your household earns over £50,000 a year, it starts to be tapered very quickly. And what happens is by the time you get to £60,000, you're not entitled to it. But the reason it's not technically means tested as such is that you have to pay that back. They don't reduce the amount you get. They just go, right, at the end of the year, they suddenly go, hold on, you earn more than, or your husband earned more than £50,000. In fact, he earned more than £60,000 here. You're not entitled to any of it. So 80 times, add it all up, you end up getting a bill of, well, potentially some people have had it for a couple of thousands over periods of time they've been claiming it and technically haven't been entitled. No one tells you that you're not entitled to it. You have to just be aware. And so you have to either put it aside, stop claiming it, and you've got to be mindful of earnings. So there was a big story this week and a bit of a discussion on my Twitter timeline, because I highlighted this to people, that what happens is that people therefore have decided, I'm not going to claim child benefit because we're not entitled to it, are we? Because you earn over £50,000, don't you? Now, one of the issues I'll come on to is, well, I'd say it now actually, that rule is slightly unfair. I don't like to use the word unfair with money, but it is unfair, because if the husband and wife earned £49,999 and both of them did it, so they almost combined earned £100,000 together, then there is no reduction going on. It's actually if only one of you gets over that £50,000 mark. Ridiculous as it is, but there you go. But what could happen is that let's say it's the wife in this scenario goes, look, there's no point us claiming, is there? Or the husband goes, look, I earn over £50,000. I'm not getting into claiming it and then having to pay it back through a tax return. I don't even do a tax return. My advice is you've got to register for it still, because now you can register for child benefit, but tick a box to say you don't want to receive it. And the reason that is important is because if you stop working for a period of time, and let's say the wife does, she stops working and stays at home to look after the children, she stops accruing national insurance credits. And those national insurance credits are what determine her state pension when she gets to state pension age. And so she would get to state pension and think, well, I'm going to get to state pension age, I'm going to get a full state pension, and realise she's got a massive gap in her national insurance record and won't get it. So it's important to still claim it, fill the form in, but say you don't want to receive it, and you will still get those credits. And unfortunately, there are a lot of people who are making the mistake of just going, well, I don't want the hassle, I don't want it, we won't register for it. Register for it, because it's your state pension that you're protecting. Moving on quickly, mortgages. We'll do our piece on whether to pay down a mortgage. It's quite an interesting debate. Now, it's up to you. It's sort of a personal choice, really. My own view is that if you pay down a mortgage, you've got to realise that the money will be locked away. So get it back out again, you're going to have to either remortgage, which if you fix your mortgage might give you a penalty, or you're going to have to sell your house. So maintain flexibility is one of the things I always try and do. So you could pay down a bit and then put some money aside into a savings account. There's a bit more of a nuance about whether you pay down a mortgage or not. It may be a good topic to come back to on the podcast. We have done it, I think, once before, but if people want us to come back to it, then we can. And then it got into putting money into pensions and ISAs. Now, great, do it if you can. I'm again about flexibility. For somebody who's a director of a business, it's always handy to pay into a pension because you can then reduce your tax bill. I mean, other people reduce their tax bills in the same way if they make pension contributions, because you get tax relief on the money going in. You don't on an ISA. But directors use it quite a lot on when they're doing their finances, because they'll probably do self-assessment tax returns. They can use it as a way of reducing their tax bill. Which one do you use? Is again flexibility of ISAs. You can get the money out when you want versus putting money away into a pension that's locked away. So again, it's not an either or decision. I just would say to people, be flexible. Seek advice if you don't know. If you don't know what to do, see a financial advisor. Find one via vouchfor.co. like I said. But there are plenty of services out there if you just want to open a pension to start putting money in. Robo-advisors out there, or an ISA. So I won't go into those, but there are plenty of services now that you can use or look at. Go on Money to the Masses. We reviewed most of them. So you can have Vanguard, Money Farm, Nutmeg. We've looked at them all pretty much. So you can have a look at them and have an idea. So I hope I've given people a bit of a whistle-stop tour of a sort of high-level thinking of what you might look at if you're looking at a scenario like this, and they can take the bits that they want out of it. It's not doesn't cover everything. Ultimately, you need to seek financial advice, but it covers the main things that you might want to look at.
Beautiful. Are we done?
I think we're done, Andy. I think those sorts of scenarios are quite interesting. Maybe people should send in more, and we can cover some of them, because what will happen by overlaying them, we cover everything, and there'll be bits that are pulled out in different ones, because like I say, we can't give advice, but we can give people the key bits, and over time you'll see there's a lot of similarity in a lot of scenarios, but there are some sort of nuances that you can do your own pick and mix, a bit like when I think it's John Lewis who has just done you can make your own pick and mix Quality Street now. Did you see that, Andy?
No, I didn't.
So now you buy the Quality Street tins, and you've got all the ones you don't like. Now for Christmas, one of the department stores allow you to go in there and make your own tins. It's just full of the ones you want. So nice. It's kind of like that. You can pick and mix and get the bits you cherry pick. So I quite like doing those sort of scenarios, because it makes me think, and it gets I suppose some people might find it more useful.
Good. So if you want to get in touch with Damien on just what we talked about there, and if you have your own ideas or suggestions or feedback, then please do. It's at Money to the Masses with a number 2. That's Damien's Twitter. And of course, you can always email him directly. It's damien@moneytothemasses.com. Damien, I'm sorry if I meant to mention at the start of the podcast, sorry if I sound a little bit different this week. I'm in a slightly more echoey environment. I'm actually house sitting. In fact, you are too. We're both in other people's houses today.
Yeah, it sounds like we're live broadcasting a double burglary. We're in houses we don't own. So yeah, you sound like you're in the Royal Albert Hall though, Andy. That's the difference, I think.
It's very high ceilings. I'm actually dog sitting, and before the pod, you got to meet little Bertie. I say little; he's absolutely massive.
I took a picture of him. I might share it on social media actually. He's quite cute for a big dog. Anyway, we're done for this week. Please leave a review as ever. I will look at the reviews and read out the latest ones. And I think that's it.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.